Are you ready? Is this the most important of the 5 reviews? Some people that I know might think so. Welcome back, and the last finale of this series. Well, I'm probably going to do a summation video, maybe with a guest. So we are now at part 5. Okay, new year, new you. I encourage you, if you have not started contributing to your 401k, 403b, 457, whatever, at least, like I said in the 20-year-old checklist, if your employer's matching immediately right now, whatever they're matching, that's your percentage. If it's 3, 4, 5, do it. You're missing out on compensation. It's insanity not to take it. If they don't offer you a match, then what I would tell you is, okay, if you're like 20, can you do 1%? And I know you'll probably say you're living dollar to dollar and you can't do it. Try 1%. That's how I started. Okay. And then a year later, 2%. And then, hey, I can magically afford 2%, and then maybe 3%. And then before you know it, you're like 30 years old and you're contributing like 8, 9% of your income in your 401k. And you're like, wow, this is not that hard. Okay. So we're in the finale, total world stock market investor. This is the last of the 5 that we will cover. I know there's more. I saw some other portfolio allocations that honestly look insane, way overly complex for like complexity for the sake of nothing, almost, to me. These 5 logically make sense for you, I think. So that's why I covered these 5 different allocations for your retirement account. So total world. So this kind of caveats to the first one. The first one, we said you just do the S&P 500 because that's what Warren Buffett would tell you to do. So this is now you're investing in every stock in the world. You are 100% equity investor of all the stocks in the world. Although, granted, you might not have the unnecessary options. I don't have a total U.S. market fund, and your international ETF that's in your 401k might not be all the international stocks in the world. It might just be like the mid and the large cap internationals, something like that. It's the same principle. You got to do the best you can. That's all I can tell you. So the reason you would do this is there are cycles over long periods of time. International perform well, and sometimes US perform well. I can tell you right now, though, long-term, historically, these are the 2 best performing types of investments in your 401k. These both have outperformed bond investments. Okay. So why would you do this? Because these are probably the best return potential investments in your 401k would be an international and a US stock market ETF or mutual fund. I'm sorry. But you can see you will benefit in all periods. So if international do well, which international did pretty well actually this year in culmination with the US. So you benefit from all of this exposure. Okay. So there's 2 primary, and you're going to have to, now here you have to do some work. That's the one part of doing this, because I've never heard of a 401k that has a global mutual fund in it. If it is, then this is easy to do. If you're like me and you don't have it, so now you have to create this. Okay. So now we'll get into that, but the 2 global indexes that you could research to figure out how you're going to do the allocations. So this is one. It's MSCI has a global index, and this is from their website. So because you're going to have to do rebalancing if you do this. So you can come on here, you can scroll down, country weights are here. That's one index. VT follows a different global index, and this is every stock. Whereas the MSCI one is like, I think that one, they don't take every stock in the world. They're basically taking, like, I think they said 85 or 88% of the world market cap companies, and they're putting them in that. So they come to the same almost, when you actually look at their weightings by country, it's almost identical. So you pick one, and then every year, let's say, you're going to pull it up and you're going to slightly tweak your balances to accommodate for changes between the US and the international. So we're talking about rebalancing of like 0.5%, quarter. Honestly, if it's like 0.25% change, you might not even bother. So this is very easy to manage. So why would you do this, right? So I just pulled up some articles for VT because VT is basically what this investment style is. You're buying every stock, or as best as you can with the choices that your company gives you. You're trying to buy the world, all the stocks in the world, right? So you are buying the haystack. You're not buying, right, the needle. You will have exposure to all the companies in the world. So any of them that run and perform, you're going to have exposure, and you won't have any bonds, which historically don't perform as well. You don't care about volatility if you do this. You are committed to returns, right? Volatility and drawdown don't matter to you in this portfolio. And there's many people where that could be true. So getting through, basically, let's see, cover any ideas here. So basically, you are a believer in efficient market theory that says there's no possible way anybody could predict outperformance of any type. So if you were just going to be an S&P 500 investor in your portfolio, you're believing that the U.S. is going to continue to outperform the international, which it has the last 15 years. If you do a target date fund, again, you are technically assuming that the decision makers at whatever target date fund is that you're using, T. Rowe, Vanguard, or whatever, are making the proper adjustments of weighting. So again, there's people making decisions. This style, there's absolutely no decision making. You're just buying everything in the world, and you're letting the efficient markets just do their thing your whole career. So you're taking the most passive theory, but it's not the most passive style for you, because you will have to make adjustments if you don't have a world mutual fund in your 401k options. So it's pretty easy. You're going to have, I think, the best chance of higher, or you're going to have good returns. I mean, obviously, historically, S&P 500 only could continue to do better than you. But as we see here, I've covered this before. Oh, they changed it. Okay, let me go to the 1 year, because I can't do the 2024. But you can see for 1 year, there are markets that did better than the US. Or let's check out 3 year, because I haven't done this before. So in the last 3 years, Mexico, Greece, Saudi Arabia, Italy, India, France. So all these countries have performed better than the US market. So with a world exposure basket, you will have these. Whereas if you're just S&P 500, you're doing good. You're doing great, but you didn't capture any of that above you. Okay. So it's tricky because, so here's the tricky part. Again, the flaws of this. You might not actually be able to do this easily. So again, for my choices, I don't have a US market, or my wife and me don't have a US market option. We have an S&P 500 option. Then we have a mid cap and a small cap. So to actually truly create a basket of the entire world, I would have to buy 3 funds for the US and then 1 fund for the international. So I'd actually have to buy 4 funds. Then I would have to figure out the weightings. I would have to figure out the weighting of the international US. Then I would have to figure out the weighting of the S&P 500 to the mid cap and to the small cap in the US. So I have to do 2 separate calculations for allocations. So I've kind of taken away the whole benefit of this investment style, because now it's not the investment style, it's the choices I have, which make it basically arduous to do this. So that's why you might not want to do this. Now you could just say, I'll just do the S&P 500 because that's like 85% of the US market cap. Let's not get fancy with the rest of it, because it doesn't really matter, for most of the time. You're technically not investing in the world at that point. You're then investing in the international side, which you might not even have that great of an international option. So this could be difficult for you to do based on your options through your employer. Again, if I wanted to do it through here, I would pick this. So this one, again, it's an S&P 500. It's not the US. I would then have to find a mid cap, the Russell 2500, and then I'd have to pick a small cap. So I could probably, honestly though, like this mid cap and the one large cap, I could probably capture over 95% of the US market cap. So I could do this in 3 funds. If I was going to do this, I would use 3 funds in here. My wife probably would have to use 4 funds though, because she doesn't have the same basket. That's why I say that I wouldn't consider that what I do this. I do like a modified target date. But it's honestly, I'm pretty close to the idea of trying to capture the world's equity markets, and I don't believe in bond exposure for my situation. For me specifically, I don't need bond exposure, and I'm willing to take the volatility. So that's VT, or the total US or total world market investor. So we will look at performance now. So so we're kind of culminating it all. So this is the US, this is the international mutual fund for Vanguard, and this is the total US bond market for Vanguard mutual funds. So number one is an approximation of the world, right? I got it as close as I could right now, 62.37 US to international. Number two, I did the 3-fund Boglehead, the initial allocation, which assumes 60-20-20, and then I did a 60-40 that we just covered. So if I analyze this, and I went from 2020 to present day, okay? So basically, like we said, number one will give you, historically, last 20-something years, a total world investor did better than the other two options. So you did slightly better per year. You can see, though, standard deviation, you have best returns. You also had the most volatility at the same time. So you had your best years were better. Your worst years were worse in these. Okay. Sharpe ratio, not hugely different. So if we go to drawdowns, again, I mean, this is not surprising to anyone. Pretty close. But when things go bad, again, number one, you're going to get the most drawdown because you're 100% in equities, and equities are more volatile without bond exposure, which is the bonds give you that, less volatility. So when bad times are bad, they're not as bad with bonds. That's the whole point. If you can't tolerate volatility, you need some bond exposure. Depending on your career choices, it just depends, and your family. So again, you could see it, same thing. So the number one went down the most in 2020. Number two, because it had bond exposure, right? It had bond exposure to decrease the volatility. Number three had more bond exposure, even better. So that's why you would do the bond part. I like this option. If I had to summarize, this option's probably, I think a lot of people will probably be hard. It'll be hard to do a true world indexing. It depends on the choices. But I mean, in essence, you could just pick the total US or the S&P 500 option at your work, and the international option, the lowest fee, most diverse ones. You're close to the same idea. And there you go. You're doing this. I think this is probably, I mean, if you're 20, this is going to give you your best return, I think. So, because you're not depending on one country's stock market, and there are countries that have outperformed the US in recent history, and you probably want exposure to them. So here's number 5. This is that option, the world stock picking efficient market person. I don't know what you want to call them. So this is the culmination of this. I might do one follow-up live stream on this with a guest. I'm going to see if I can line that up, because I'm not the biggest expert. I'm not a Boglehead, and I'm not a big expert on bonds. So maybe I can have someone with that more discuss it. So what I've done, I could tell you what I do maybe in the live stream, but like for briefly here, I look at a target date 2045 for Schwab. Schwab has two, actually. They have an indexed version, and they have a normal retirement. They're two different portfolios. I look at what Schwab does every year once, and then I modify it. I take, if they have like a separate REIT, I already showed this in one, like they had a REIT ETF in one of their target date 2045s. I took that completely out. I took the bond exposure, I put to like 5%, and then I filled in the gaps basically with a little extra exposure international. I bumped it up a few points, and then I bumped up the mid cap exposure a few points. So like I said, I do like a modified target date, which works for me, and my risk profile and the fact that I have a pension. I don't feel I need, and I have a secure job, so I don't feel I need bonds to alleviate volatility. So, but I think all 5 of these, to summarize here, all 5 of these have a place, right? Some of them you might think, oh, this one's a trash op. It depends on who you are, your family situation, your job, if you have other assets. when are you retiring? Are you retiring at 55, or are you going to retire or never retire and you plan to work your whole life? Those are all going to be dependent, like have to be factored in for this decisions. But here, I mean, I did talk to some other people. These are like the 5 most prevalent options I saw. If you see other allocation methods, I saw some stuff that was like 10, it was like 10 like ETF or baskets of stocks and bonds and stable income. And like some people go crazy with this stuff, and it was too much. It was just too much. I think these are the 5 most logical ideas for your retirement account. So that's this series. Hopefully you pick one of these. I mean, the only bad choice, or I would say there is a bad choice. If you are 100% cash in your 401k, you've made a terrible decision. So that is the one wrong choice. So with that said, thanks for watching, and we will see you later.